Hello, hello. Hi, everyone. I think it takes Zoom a couple of seconds to connect audio, so I'll let people settle in. But thank you so much, everyone, for joining us for this live webinar. We have a very interesting topic to cover today, and I'm very excited to have Christian on the panel as well. Before I get into all of that, I'll wait for maybe a minute or two. I know it often takes people to, grab coffee, settle in among all the workfalls, and find a place to attend this webinar. So I'll wait for people to join in. We already have quite a few guests I can see here. Actually, it would be interesting to see where people are joining us from. So would request everyone on the chat to share, where are you joining this webinar from? It's always interesting to see how webinars enable a global audience to connect. So it will also help us see if Zoom is working fine, everyone can hear me and the chat is accessible. Oh, thanks. I see Dea from Toronto. Hello, Irene from Minnesota. Chris from New York. Not very far. I'm here in Hoboken, New Jersey. Awesome. I'll give this a minute or two. I'll request everyone else to also post where they are joining from, and we'll start in another minute. Awesome. Good to see Mariel from Florida. Yes, Jay will make sure to send everyone recording of the session as well. Awesome. So once again, welcome everyone to this live webinar where we are going to unpack how top finance leaders maximize forecast accuracy. We have Christian as our speaker today, but before I introduce and let him take over, I want to take a minute to introduce Zenskar. Zenskar is an AI native order to cash platform built ground up to automate finance workflows with intelligent agents and human in the loop reliability. We serve finance teams who are scaling fast but don't want to scale headcount just for revenue operations. Zenskar automates the entire revenue workflow using intelligent agents, from ingesting your contracts to generating invoices, syncing journal entries with your ERP, and surfacing actionable insights. All gets done without any manual effort. This makes sure that your team and you can focus on strategic decisions and no data entry, reconciliation, or repetitive manual work. I'll come back to more about Zenskar in a bit, but without further ado, I want to introduce our guest speaker for today, Christian. Christian is an FP&A expert with over a decade of leadership experience at multinational companies and fast-growing tech startups. Today, Christian directs the FP&A certificate program at Wharton School of the University of Pennsylvania and often shares his insight through his training programs as the founder of Inside FP&A and also on LinkedIn. I'm sure most of you know that already. Over 30,000 finance professionals and business leaders subscribe to his weekly newsletter. So if you haven't, you should check out what Christian sends almost every week and called FP&A Tuesday. You can discover more about his work on insidefpna.com. I'll pause now and let Christian take over. Over to you, Christian.
Thank you, Priya. I'm excited to be here and excited to talk about one of my absolute favorite topics to teach, which is improving forecast accuracy. So let me share my slides. While I'm sharing my slides, actually, Priya, I just noticed that people are, when they enter something in the chat, they chat with hosts and panelists. Can you change it in the setting that they can chat with everyone so everyone can see the chat messages? You can do that under participants. And yeah, you should be able to see my screen now. What's special about this session, and also a bit different from the other webinars I've done, is that this is a workshop, not a passive lecture. So what this means is that I want this to be a two-way discussion here. I will, of course, teach the concepts, but then I will frequently ask you questions and ask that you use the chat to participate and you to contribute, because that will make it more engaging and more fun for you, and it will also make it more fun and engaging for me as an instructor. And also very important, questions are always welcome. There's a Q&A button next to the chat button. Please feel free to ask your questions there at any time. If it makes sense with the flow and where we're at, then I'll answer them right away. Otherwise, we'll reserve the last few minutes for questions. Now, without further ado, let me jump in with a warm-up question. So, why is forecast accuracy important? What do you think? You can type that in the chat. Why is forecast accuracy important? It's just a warm-up question. It's a very simple question, I'm sure. I'm sure you can come up with a lot of reasons. Gives you credibility, okay, to tackle uncertainty. Cash flow, 3 exclamation marks. Yeah, Irene, it's important to get a handle on where we will be in terms of cash flow, because that allows us to make decisions about what we can spend money on, right? Resource allocation, inventory management, plan accordingly. Steven says to mitigate risks. Raphael says it's a guide. Yeah, it's a guide for decision making. Jason says to plan for the future. Sophie says during M&A discussions. Yeah, you raised already most of the points. I have a few more here. So, of course, it's about resource allocation. You need to know what the impact is of your actions, how that will impact your cash flow, your profit over time, to help you make decisions into where do we want to spend more. Risk management, also again connected to cash flow. Thanks again to Irene for calling that out. Strategic planning, we'll talk about that. Performance measurement, in other words, how well are we doing? The forecast can be a benchmark for that. But also things like investor confidence, right? If you share external guidance, if you're a public company, or even when you're a private company with your investors, and you don't hit that number, that can erode confidence, which can lead to less funding in the future or a drop in your share price if you are a public company. But it's not just about the financials, it's also about connecting operational metrics with the financials and getting a read on operational efficiency, market responsiveness, and of course, financial health. So now I'd like to introduce a few important concepts before we go into forecasting techniques, because these concepts are sometimes misunderstood. So the first one is rolling forecasts. Most of us here in the call, I saw our finance leaders have experience with finance. But the term rolling forecast is sometimes used in different contexts. Some people mean one thing with it, some people mean another thing with it. Based on your experience, what's a rolling forecast? How have you used the term in the past? There are a few different definitions. None of them are incorrect. It's just important to define it. What's a rolling forecast? Sophie says live up-to-date view. Vinny says ongoing forecast. Yeah, so there are a few different definitions. Some people call a rolling forecast just a forecast that gets updated every month. That I would argue is table stakes. Unless you are a very small company with a very simple business, every company should update the forecast monthly. But there is some more, I look at rolling forecasts differently, because yes, thank you, Jason. So I define rolling forecast similarly to how Jason defines it, which is forecast updated with the latest information and continues out 12 to 18 months. Because a lot of companies are still doing the traditional forecast. If you look at the slide, that's the box at the top. Basically, you forecast until the end of your fiscal year. From a lot of companies, that's December. And then the closer you get to the fiscal year, the fewer months you have to forecast, right? In October, you only forecast 3 months, in November 2, and in December, you only forecast 1 month. That's the traditional way. The way I define a rolling forecast is, yes, you refresh your forecast monthly, but you always forecast either 12 or 18 months, exactly how as Jason said. And there are a few implications of doing it this way. There are a few advantages, but there are also some dangers. And I have some theories why a lot of companies are not doing the rolling forecast as I have it here in the lower box. But what do you think? What are advantages? And this, let's start with the advantages of implementing a rolling forecast. So let me put it back to this slide. What are the advantages of doing the forecast the way I have it here in the box in the bottom? What do you think? Mariel says better strategy oversight and decision making. Yeah, strategy in the sense of that some strategies take longer than by the end of the fiscal year to carry out, right? In a sense, the end of the fiscal year is uh, a very made up endpoint, right? Of course, we need the fiscal year because that's how investors are looking at the company performance, but not necessarily how decisions are made. Provide more frequent updates and faster response. Removes the blind spot at the beginning of the next period. Thank you, Jacob. Really good point. That's especially an issue when you're in September, October, and the budget isn't done yet for the next year, but the teams across the company have to sign contracts and make decisions about investments for the first quarter. So that can sometimes really slow decision making down if you don't have that. Time won't stop. Yeah, Sophie. So other advantages are that in the traditional forecast, forecasting gets easier the closer you get to the end of the fiscal year. But while that's nice, it's not necessarily best practice, right? You want to train your forecasting muscle. And because forecasting something that's 10 months out is very different than forecasting something that's 1 or 2 months out, right? You lose different techniques. We talk about techniques in a moment, but that's a different approach. And if you do the rolling forecast, where you always forecast 12 months, you continue to build that muscle, to refine your techniques, you'll get better at it over time, and it gets easier over time. You don't have that in a traditional forecast. Are there any risks involved with doing the rolling forecast, or any reasons you can think of that make it so that most companies or many companies don't do that? Why do you think? What do you think could be dangers with doing a rolling forecast, disadvantages, and reasons for companies not to do that? Okay, you raised already a few good points. Lack of resources, significant lift on finance team. Thank you, Ben. A lack of long-term planning to support the forecast. Thank you, Lisha. Complexity of the company. So yeah, it comes down to the issue that leaders think, okay, this will take much more time, more resources if we do this. That's number one. But actually, what I've seen in reality is you get practice. You keep doing that for a number of cycles because you always have the same planning horizon. The task is always the same every month. And so you bring in new news, you use different methods, but you refine and you become faster. So that's actually less of an issue. May not align to the planning cadence of the business. Yes, Tatum. Often, what I've seen is a big reason why companies don't do this is because senior leadership isn't asking for it. Because people only worry about the current fiscal year, and they only start worrying about the next fiscal year when they're in the middle of the budgeting process. But it can be difficult to get people to worry. Now, I would argue we should, as finance leaders who want to look at sustainable growth, at long-term growth, we should encourage people to think longer term. Now, of course, to the point of Jason, if there is complexity or you're very early stage, you haven't found your product market fit yet, if you're at a startup, it may not add a lot of value to forecast that far out. But for any established companies, I would recommend you consider it. So with that out of the way, I want to discuss another super important core concept of forecasting, and that's top-down and bottom-up forecasting. What is top-down forecasting? I'm sure some of you here have heard those terms before. What's top-down forecasting in the context of top-down versus bottom-up? Give you a moment. Yeah, Jason, executive team provides the targets downstream. Lisha says goals set by leadership comes from the leadership at a macro level. You're on the right path. So top-down forecasting starts with an end result in mind, right? We need to grow revenue by 7% next year because that's the investor expectation. Let's see if that's feasible, right? And then you back into that. It's about expectation setting, but it shouldn't be just wishful thinking. It needs to link ideally with a strategic plan. And even though it's top down and high level, it needs to be done on a business driver level. What that means is you can't just say, well, we should be able to get 7% revenue growth next year. You need to look at, okay, how can we make that happen, right? What do the resources look like? What are we planning to do differently next year to get that growth, right? Be it in terms of hiring more people, spending more or in different channels in advertising, spending more on sales, etc. And it also needs to take external factors into account, like what do we think our competitors will be doing in response to how we are planning to grow next year. That needs to be part of a thorough top-down as well. And what does bottom-up forecasting mean then in context here? By the way, to Rahil's point, revenue and budget is decided by exec team and given to business leaders. Ideally, finance leaders play a big role in top-down forecasting, and we'll discuss different ways how to do that in a moment. Steven says focus more on individual departments and projects. Inputs from teams, input from function, rolls up from the individual department. From net income and cash needs up to revenues to meet it. Yeah, the way I like to look at it really is based on you start with the activities. You start with the projects, the things that people are doing, right? The way they're spending money, and then you add that up. So you start from scratch. The output is the sum of all these plans. Yeah, teams build their own forecast. Thanks, Jason. And then that should include not just what people hope to achieve in terms of financial performance, but how they execute against them. So tactics, how strategies translate to tactics, how tactics are being measured, and the role that finance plays here, because finance also has an important role to play in the bottom-up forecasting process, is evaluating uncertainty. So in other words, asking challenging questions, right? You get the inputs from the different teams in the company, but then you need to figure out what's the range of likely outputs, right? Because it's never nobody has a magic crystal ball, right? Nobody can tell you exactly how many sales they're going to deliver in Q3 of next year. But then your role is to understand what's the low end of the range and what's the high end of the range so you can quantify risk. Now, let me ask you this because that's important, super important to understand this. Why should you prepare both a top-down and a bottom-up forecast? Why isn't it enough just to ask the business teams to do a detailed bottom-up? Sophie says, Lisha says to determine if the targets set by leadership are too ambitious. Sense check that they match. Chris says top down can lay out the goal, but the bottom up helps determine if it's possible to execute. Ben says fills gaps between differences. Open discussion to build consensus. Yeah, so essentially there are two main reasons to doing this. The number one reason is that it helps address bias because typically top-down forecasts that are set by senior leadership are leaning aggressive, meaning revenues are high, expenses to get those revenues are on the low side. That's usually because leaders are more ambitious, they want to challenge the team, and they're also a bit more removed from the day-to-day. Whereas bottom-up forecasts tend to be leaning conservatively. That's also just human nature. It's because the business teams want to lower expectations, right? They want to say, we will be able to drive 3% in revenue growth next year. And then they want to over-deliver, right? So they may say 3% when they think they should be reasonably able to get 5%. But they submit a more conservative number to manage expectations and then to be able to beat those expectations. So what usually happens is that you have a big gap between your top down and your bottom up. And I actually argued that that's not necessarily a bad thing. I've led 11 annual planning processes in my career, and it has never once happened that the bottom up and the top down are actually close to each other. So the key here is to use that difference as a conversation starter. And this is why it's so important that as a finance leader, you play a role in the top-down process. You don't just take what senior leadership thinks, you develop your own top-down, because then you can use that to challenge the bottom-up. Because then you're not just going to the head of marketing and say, hey, your number looks a bit low for leads. You would actually say, look, I've done a back of the envelope for how many leads we should be able to get based on what I've seen historically. My number is higher than yours. Here's why. Let's take a look at why yours is different, right? Completely different conversation. Now, which one should be prepared and shared first? The top-down or the bottom-up forecast? Which forecast should be prepared and shared first, the top-down or the bottom-up? What do you think? I like that I'm right away seeing two different suggestions. Chris says top down, it's difficult to budget to achieve a goal without knowing the goal or target. Bottom up, Mark says bottom up. So there are actually reasons to do it either way. And it really depends a bit on your corporate culture. So a lot of companies share their top down first with the teams who have to prepare the bottom up. And that's to set expectations so they know what they're working against. The issue with that, and I've actually seen this happen at a company I worked before, is when I joined and I looked at the previous year's planning process, I was surprised how close the top down and the bottom up were. I had never seen that before. And when I talked to the business teams, they told me, hey, we just submitted the number that finance was looking for, because we wanted to have an efficient planning process. We wanted to avoid all the back and forth. And in the end, we have to do whatever leadership wants anyway and put that in the forecast. So we didn't even bother with sharing our unadjusted number, And we don't want that, right? We want people to share where they actually think they can take the business and what they actually think they need to make that happen. So you can have a conversation about that, right? And so in that case, I argued, hey, we should not share the top down first. We should have people do the bottom up first for the next planning season. And there was pushback, especially the chief marketing officer said, I'm uncomfortable doing this because if I have my team do the bottom up first, we might be completely off where expectations are, right? And so essentially, she didn't want to have too much back and forth and also not embarrass herself of the team. And so what we ended up doing is we actually used the hybrid approach where we said, we won't give you the top down first, but we'll give you guardrails. So we give you a rough range of what we expect for sales, for expenses. But this may still change, but it's just so you have an idea. And that completely changed the dynamic. Their bottom up was much more conservative than it was before. There was a bigger gap between top down and bottom up, which was great because it allowed us to have deeper discussions and learn something about how the business works. Okay. So now the question, of course, becomes, I told you that having a gap between top down and bottom up is okay. What do you do when that gap happens? How do you approach the issue if there's a big gap between the top down and the bottom up your business partner has shared? How do you approach this situation? What do you do? Mario says focus first on cost alignment. Yeah, that can be helpful because cost is more decision and revenue is often more an opinion, right? So you focus on the facts first, but the two are often also intertwined if you're focusing on ROI. A discussion why the gap exists and brainstorm on ways to close the gap if possible. I really like the idea to say you brainstorm, which means that we actually, as finance leaders, we're trying to help them, right? Rather than just saying, you have to somehow get closer to our numbers. Review the drivers. Yeah, so what I would recommend is the first step is to don't even talk about the numbers, talk about the methodology. So ask questions around how did they come up with the number, what was the approach, and then mediate and translate, meaning compare how they came to the number with the assumptions that you had in your top down and see where there's a disconnect. And then to prepare for the next meeting where you talk about the numbers, you do an accuracy review. So you look at what was the forecast accuracy of that team that you're evaluating in the past. And look at, did they have a certain bias? Were they always overly optimistic or overly pessimistic? Then you look at to find common ground. You look at, are you looking at the metrics in the same way? Do you define everything the same way? Are you on the same page on that? Because sometimes you end up at different numbers simply because you're not defining metrics the same way. And then you see common objectives, remind people that, hey, we're all in this together. We all want to have the best forecast accuracy possible. So let's show some flexibility. Here are a few, because I want this to make this as practical as possible for you, a few questions you can ask the other team. Questions like, explain how you arrived at the rationale. Can you walk me through step by step? What were the external factor, the macroeconomic factors you considered? Because maybe we had different assumptions there. How have you used historical data? How were uncertainties and risks accounted for, and so on. So feel free to take a screenshot of this slide because I think these questions are helpful. So much about FP&A is about asking the right questions at the right time, right? And by the way, also the reminder, feel free to ask questions at any point in this workshop. So now, having defined those core terms, being on the same page there, let's talk about forecasting techniques. Because I argue that one of the best ways to improve forecast accuracy is to run multiple forecasting methodologies at the same time. Because if you prepare multiple scenarios, you can use them to stress test each other, you can use them to compare each other. And as you will see, some of those forecasting techniques also have very different advantages and disadvantages that you can use to offset it from each other. So I'll start with the incremental approach. It's a commonly used forecast method. It's not one of my favorites, as you will see in a moment. So how this works, and it's okay if you can't see the numbers, if this is a bit small, the high level view here is good. So basically what the incremental approach means that you apply a percentage adjustment to the actual figures of the prior year to arrive at your next year forecast. So for example, you might say, well, revenue, we need to grow by 5%. We should be able to spend and adjust our marketing expenses for inflation, increase 3%, but general and administrative expenses need to come down by 5%. That's the incremental approach. And then how you do this in Excel is you have a file here where each month you have the actual numbers of the prior year, and then you apply that percentage to each month so that you include the seasonality, if you have any, in the next year. So you multiply each month with that percentage. You can also do that on a weekly basis if you have more granular seasonality. Now, this approach has a few advantages, but even more disadvantages. So let's start with the disadvantages. What would you say are the disadvantages of the incremental approach? I'll put it back, put the slide back on. So what are the disadvantages of doing a forecast like this? Gary says linear, Depeche says oversimplified. Mario says doesn't consider current or future economic or other impacts. Prevents critical thinking. I like that, Irene. I like the word prevent there. Very easy, recurring of errors. Yeah, and what could be some advantages? Simple to do. And that's really the only advantage. So it's simple, it's quick to adjust, it can to account for seasonality. It's easy to explain to someone outside of finance. But the disadvantages are significant. So there's no forced analysis, to Irene's point, prevents critical thinking because it's so simple that you don't have to think about the business impact. You don't have to think about tactics and actions and measurement. You're too far removed from the day-to-day if you do it like this. But there's also unwanted incentives, which is actually interesting, around spending money to protect next year's budget. And that's actually also something that happened to me. I'm not going to say where it was, but I worked at a company where my business partners at the end of the year, they were all of a sudden starting to buy a bunch of furniture and replace some of our furniture. I was like, why are you doing that? I felt like these tables are still okay. They're old, but they're still okay. They're like, yeah, next year we're planning to do something, but if we don't spend our money this year, then we'll have less next year because there's every year we just get a 3% inflation adjustment to this budget. And so if we don't spend the money, we'll lose it in the next year. So we make sure to spend it. And then they argue for why, of course, they need new tables. We don't want that, right? We want people to make investment decisions according to the return on investment, not to protect the budget for next year, because you have that incremental approach. So super important. And even if you do this well, you're only focusing on new spending. You're not carefully adjusting your base for outliers or things that won't reoccur. And so I'm not saying you should never use this process, but I recommend you only use this for expenses with low strategic importance. Office stationery, right? You don't need to run a complex forecasting process for that. You can keep it simple. But now let's take a look at the next method, which I think is a lot more effective in many regards. Zero-based budgeting. The term has been around for over 20 years. So I'm curious, how would you explain briefly what zero-based budgeting is? You can type it in the chat. What's zero-based budgeting? disregarding previous year's numbers. Yeah, so the approach is said to have been invented originally by a consulting firm. I believe it was McKinsey a while back. And the idea is, yep, that you start from scratch. So there's extreme method of doing this, and there's a more balanced method. So the extreme method is to say, assume we're starting the company fresh, start with a blank spreadsheet and think about what are the expenses you want to have and how they translate to revenues. What are the vendors you want? What's the software you want? Let's start from scratch. That's only feasible for small companies, right, that are early stage. If you are a larger company, it's not, you struggle doing it like that. But it is possible to do zero-based budgeting with very large companies. I've actually was in charge for implementing zero-based budgeting for the first time at Unilever when we had, but on the marketing budget, when the size of the budget was 1.5 billion, almost 1.3 billion for North America. So you can do it even for very complex teams. But the way you do it then is you don't start from scratch, but rather you start with the expenses. So you look at where did we spend our money on, ideally on a fairly detailed level, maybe even down to the transactional level. You pull that data from your ERP system, and then the magic happens in the columns that I have shaded on the right here. First, you group the items. I have to give them a zero-based budgeting document ID, because you want to group expenses that are linked because they are enabling the same asset, the same decision. And then you go through them and you say, okay, do I want to keep this? Do I maybe renegotiate this? Or do I need to remove this expense? Because, yeah, it's not really adding value. It's not driving sales enough to be justified. What's a potential advantage of zero-based budgeting? Deeper review of expenses. Yeah, thank you, Mario. What else? Think about bias and what bias might be addressed by zero-based budgeting. Promotes ownership. Can be very conservative. Identify if costs have been around for a while and no ROI for a while. Yep. Allows accommodating of changing priorities, value-driven per revenue. Yeah, so it avoids status quo biases, right? So often it happens that people bring on a vendor and then it seems to be going fine, but for years nobody looks at, is there a better option out there? Is there a cheaper option out there? Just because, we've always been doing things that way. And so zero-based budgeting challenges that. And it's, of course, very effective if your goal is to become more efficient at a company, if you want to identify cost savings. And it helps us covering the 20% of expenses that drive 80% of the outcomes that you want to put fuel on. What are some disadvantages of zero-based budgeting, though? Can be time consuming. Yes, thank you, Deepesh. Thank you, Chris. Exactly, that's the biggest disadvantage. And there's also a risk of rewarding short-term focus. It came through, I forgot who it was, who said it can be very conservative. There's a risk that you are killing things that have a long-term return. For example, investments in sustainability can sometimes take a much longer to turn around. And so you need to be careful that you're not becoming too short-term focused when you're doing this. So when should you do it? Well, when you consider the complexity and time commitment, so don't roll it out for the entire company at once. Start with one department, the department that you're probably the biggest offender, right? And if you're been a finance leader for a while, you probably have a department in your head right now where you would want to start at first. And then also if you can consider the ease of the justification. If it's very difficult to connect the expenses to revenue, then you might be struggle with justifying and doing this. And that's why actually zero-based budgeting is most commonly used for marketing expenses, because there's a lot of complexity, many different vendors, and you can more easily connect the investment to returns. There are a few challenges with this. The challenge I encountered when I implemented this at Unilever is that the marketing team wasn't very excited to work with us on this. But you need the cross-functional team. You need them to help you getting to the items that can be cut. Finance can't do that alone. But people were not very excited about finding ways to reduce the budget, right? Nobody wants to hand back budget. Nobody wants to cut their own budget. And so the way we approached this was, well, we are not going to drop everything to the bottom line. A big chunk of the savings will actually ring fence, meaning we hold it on the side. The SVP, controls that budget, and then business teams can pitch for getting some of that money back for their investments. It's a bit like Shark Tank, if you know the TV show. And so the teams were pitching, and some marketing teams ended up with getting more money after the exercise than before because they had great ideas. And then you can put fuel on the fire, and it's not just for improving profitability. And when we framed it like that, all of a sudden people were much more happy to help finance with doing this. So that's zero-based budgeting. And then we have driver-based forecasting. So this is actually one of my favorite forecasting techniques. Let me show you why. So here's an example from an actual software company. Of course, the numbers are different, the line items are a bit different, but it's very similar to the driver-based forecast we've built for their subscription model when I was leading the FP&A team there. And how the driver-based forecast works is you start with what are the things we want to do differently in the business? Where do we want to pull a lever? Where do we want to spend more? What do we want to do? And then you translate that to revenue, or in this case, we translated it to subscriptions, which then in the next step got translated to revenue. And so, for example, we would look at things like unaided awareness increase. We wanted to spend more on brand building, on the name recognition. And so then we estimated what's the impact there. We spent more on the direct response budget. So that's the marketing dollars that go to ads. But we also accounted for external impacts like inflation, a new promo strategy, which actually was planned to result in a drop, and a few other adjustments. And that's also another thing, what I really like about this technique is it's easy to have a conservative, a balanced, and an aggressive scenario. And what this does is that, so the way you do that is when you put together the relationship between the business driver and the financials, you look at the margin of error, you look at the range of possible outcomes, and you have a low end and a high end, and you have a midpoint. And when you do it that way, probably you start with the balanced approach first. You look at what this 4 million subscriptions, what it would give us in terms of revenue, and that might not be what leadership is looking for, right? That might not match a top-down. And then you can say, okay, unaided awareness, we spend a lot of effort into analyzing that. We've done it in the past. We think we can go with the aggressive scenario. And then you take a bit more risk. But you might not want to go to the aggressive scenario with other drivers. And what's the beauty of that is that it makes it easy to tell the financial story of the business, to explain to the board of directors, to senior leadership, how much risk you're taking, where you're taking the risk, and why. I don't want to take too much away from that. I want to ask you, any other advantages that come to mind with driver-based forecasting? Bring it back here. There's another major advantage that I haven't, two major advantages that I haven't mentioned yet. Sophie says tracking driver-based KPIs versus forecast. Yeah, so now we're looking at KPIs, so operational metrics, performance indicators that the cross-functional team is tracking already. And that has the advantage that you are forced to get closer to the business to understand what's really going on. And it also makes it easier for leaders across the company to buy into the forecast, because now it's not just a nebulous number that finance has, they can't reconcile, but they can link the financial forecast with what they're changing in operations. So that makes it so that the collaboration with the cross-functional teams gets easier. Accommodates changes in values easily. Thank you, Tatum. That's the other major advantage, is that it's useful throughout the entire year. So whenever you get new news, you tweak that number. And so the driver-based forecast stays useful throughout the entirety of the year. Any disadvantages that come to mind? I'll help you there. So the disadvantage is that a bit of mirror of the advantage, that you need to be close to the business. You need to have a strong understanding of the business. If you don't have that, it can be time intensive and can be difficult to do. The other challenge is the risk of error stacking. So basically, you need to be careful that you don't have a list of 20 drivers, because then uncertainty in each driver adds up. Sometimes they're interrelated, it can multiply, and then it becomes difficult to, then the accuracy can go down. And Sophie also raised a great point in the chat, saying that need functions to allow you that close. Exactly. So if you don't have a culture where finance operates close hand in hand with the business teams and the trust isn't there, there might be a challenge for you to build that. But I would even see that as an advantage, because starting a process like that helps you gradually build that trust and get closer to the other teams. So driver-based planning, highly effective for revenue planning or combining with other methods for expenses. So to close out this session, I wanted to share a few quick best practices for driver-based planning, again, because I think it's just such a useful technique. Business drivers are not the same as P&L lines. It needs to be detailed enough to align with concrete tactics. So you can't just say advertising, we spend more in marketing, that's a driver. That's not detailed enough. It needs to be close enough that operational metrics, the things that the business teams are actually driving, can be linked there. You need an 80-20 approach. You need to, and that's sometimes the hardest part, is that there are so many moving pieces, so many things the business is planning to do differently next year. You need to figure out what are the 8 to 15 things that really move the needle, and only include those in your driver-based plan. Because again, otherwise it becomes too complex, it becomes too difficult to keep up to date, and you have the error stacking issue. And then lastly, I mentioned that already, you need to collaborate. You can't do that on your own. You may think that you know the business well enough, but your driver-based forecast will be a lot better if you do it together with the other teams. So this is all I wanted to share with you. Now I'm handing it over to Apurv from the Zenskar team.
Hey everyone, how's it going? Nice to meet you. Am I audible okay?
Yes.
Awesome. Well, thanks a lot for, listening in. I hope you all enjoyed the session. I am one of the co-founders and CEO here at Zenskar, an AI native order to cash platform. I wanted to just take a couple of minutes showing you what the latest in AI for finance looks like, especially when it comes to, your order to cash workflows. So I'll maybe take a couple of minutes to walk you through what we've built here at Zenskar, and I'd be happy to answer any questions that you might have as I go through this. Is my screen visible?
Yes.
Awesome. So at Zenska, our larger vision is we're building an AI native platform that automates your order to cash. We just need two sources of information, your sales contracts and your usage information. Using that, our AI automatically manages your billing, your revenue accounting, your SaaS metrics reporting. We're building in an era where most software in the future will be accessible using a chat-based interface as opposed to point and clicks, like you use ChatGPT. And the larger vision we're enabling is zero-day close. So I'll kind of dive deeper into the platform very quickly. So let's say you have your contracts living in a drive. You can just upload your contracts. Our AI reads through the contracts, no matter how complex or how long they may be. It's a 20, 30 page document. The AI will read through them. The best part is you have a human in the loop reliability because the AI is not 100% accurate. So it picks up the nuances in the contracts and you can come in and edit them, saying that, hey, you know what, it could be a per unit price, perhaps maybe a tiered price, let's say a percentage based pricing, define whether it's more fixed pricing or metered, a recurring fee, maybe a one-time fee, is it prepaid, postpaid, define whether you want to offer, let's say, discounts, credits, tax, minimum commitments and whatnot. In some cases, your contracts actually live inside your CRM. So you can go hook up your CRM, and Zenska would pull in the sales information from the CRM. If you bill based on usage, you could go hook up your data sources into Zenska, where we could fetch the consumption information from, or you could send this to us using an API. Zenskar's AI automatically generates the invoices. These invoices can be reviewed by you or directly sent to your customers directly. Now, given that we have all the information in Zenskar from your contracts and your usage, our analytics module actually gives you a lot of the reporting capabilities that you might look for on a daily basis. So let's say your MRR, your ARR, broken down by customer, by geography, by expansion, contraction, net new, revenue waterfall, deferred revenue. The list goes on and on, churn reporting. While we give a lot of off-the-shelf charts, I think the beauty in the platform lies in the fact that you don't have to download data outside the platform to customize any reports. This is all built on top of Metabase, a visualization tool. So you can come into Zenskar, access all your data within Zenskar and build any custom reports. Let's say you have a different ARR definition or a different way you define churn. All of that can be built on Zenskar in itself. And you can actually leverage our AI assistant to chat with it and ask it, hey, what's my MRR? And we took a couple of years to build this out. It's pretty powerful. It real time accesses all your data. It'll think, it'll decide, understand your question. You can write follow-up questions, write prompts to it, and it gives you the answer on whatever question you ask it. So you can access all your data through this agent and chat with it. And lastly, once your contracts are in Zenskar, our accounting module, which is actually fully decoupled from our billing module. So in Zenskar, billing and RevRec are fully decoupled. Our contracts, your contracts and users define your billing, and your contracts and users separately define your RevRec. So as you see here, just like in 606, the performance obligations get generated based on the contracts. It defines your revenue distribution based on usage, or maybe straight line based on subscription. You could come in and define some revenue rules, how you want to recognize your revenue, point in time, over time, based on usage, equally by days, month, whatnot. And Zenskar then generates your reports, your deferred revenue, unbilled. It creates your final journal entries. It acts as your sub ledger essentially, create journal entries at a granular level, at a customer level, and posts all of this essentially into your ERP. So yeah, that's a super high level overview. Of course, happy to answer any follow-up question that you might have, but that's a sneak peek into the platform and how it leverages AI to automate your order to cash.
Thank you so much for sharing that. Always so exciting to see what these tools are able to do in these day and age. It's really hard to know this without seeing those tools in action. So thanks a lot for sharing that. We still have 5 minutes, so if you have any questions about what you just saw, about Zenskar, about forecasting, about anything FP&A related, fire away. I'll check questions in the chat. So someone asked about the slides. We will share the recording. So keep an eye out for that. What else? While you're thinking about that, I wanted to thank you for being so engaged throughout the workshops, for answering all the questions I threw at you. Made that, I think, a lot more interesting for everyone included here. So thanks a lot for being so engaged. Jay asked how to make it real time as opposed to batch processing the reporting. So to make the reporting real time, tools like Zenskar can help, right? And maybe Approve. You want to touch on that, real time versus batch processing?
Yeah, I mean, it really depends on, on what cadence you have availability to your data, how frequently the data actually gets updated. So reporting involves A, having access to data, and B, processing the data. So if your data is not updated at a real-time level and it is, batch processed, you cannot have real-time reporting. And even if your data is actually, available in real time from different sources, let's say your sales contracts, your usage or whatnot, if you don't process it in real time, you can't have reporting in real time. So the benefit of, let's say, a tool like Zenskar as opposed to, let's say, doing stuff on spreadsheets is that in real time, it is connected to different sources within your, tech stack, your CRM, your ERP, your usage. And as a result, it has real-time access to all your data as the data gets updated. And given the fact that our AI agents run processing, pretty much all the time, your reports also get updated, instantaneously. So neither is the data availability being batch processed, nor is the processing being done in a batch process way. So that's the benefit of having a tool like Zenskar that helps you kind of have all of this in a real-time basis.
Yeah, thank you, Apurv. So AI agents make a big difference. Someone asked, is a CPA necessary to progress in FP&A? And the clear answer there is no. So it is important to have some accounting background, but if you want to work in a pure FP&A role, at a larger company where you don't have accounting tasks, you don't need a CPA. The area where that can be helpful is if you work at a small company where you have shared responsibility, you have some accounting tasks, you have some FP&A tasks, then the CPA can make a difference, but really only with your accounting tasks. A CPA does not teach you how to do FP&A. Then Chris asks, how do you recommend building buy-in from key stakeholders in the forecasting process who are not financially minded? Yeah, so buy-in can be a big difference. Look, whenever it comes to buy-in, there are two ways you can approach it, top-down or bottom-up. Bottom-up, showing them how improving forecast accuracy can actually help them make better decisions, and essentially how you can help them by giving them insights into changes to trends earlier, by giving them, an early warning before, so they have more time to make decisions. That's the bottom-up approach. But then with establishing a process like that, it's also really important that people at the very top are aligned and are communicating that down. So make sure that the CEO or the VP of that department, the head of that department, understands that you're working on building that process, understands that you as the finance leader have more time to do this actually, because maybe they thought, okay, finance can't support this. But when they realize that you have the ability, the time, the willingness to do this, they have to communicate it to their team and basically tell them, look, finance is ready to step it up, to add more value in the forecasting process. Please support them. Please work with them. Super important for buy-in to have that trust bottom up and that messaging top down. Someone asks, what is the best starting point for working with a new team who have never engaged in forecasting before and are reluctant to start, potentially from fear of being held to it and it being wrong? Some practical first steps for introducing the conversation would be great. Yeah, you're raising some good points where people sometimes misinterpret forecasts. So forecasting and target setting are two very different things. Just because they put something in a forecast doesn't mean that now we are targeting that number. It doesn't mean that they're being held accountable to that number. It's just information sharing. It's just sharing where do we think we'll end up. So it's important to make that message clear, ideally by having a separate target process and being very clear about your targets beforehand and saying, well, how you submit the forecast, how you participate there doesn't impact directly your incentive structure. So yeah, thanks so much for your questions. With that, we are at the end of the time. So really appreciate it.
Thank you all.